Are you concerned about the economy and the possibility of a recession in 2023? If so, you're not alone. Many experts are predicting a downturn, and one key indicator is that pricing is currently reflecting a nearly 100% chance of a Powell recession in the coming year. But don't panic just yet. While it's important to be aware of the potential for a recession, there are steps you can take to protect yourself and your finances. It's all about being proactive and making smart financial decisions. According to the findings of a study conducted by DataTrek, the New York Fed's recession probability model predicts that a Powell recession will occur in the year 2023. The model calculates the difference in yields between the 3-month and 10-year Treasury notes, which is a well-known indicator that a recession is on the horizon when the curve becomes inverted. The 3 to 10-year Treasury yield curve has been considered as an excellent predictor by financial experts, and Federal Reserve Chairman Jerome Powell has stated in the past that it is his preferred recession warning. According to the New York Fed, it is now indicating a 38% probability of a recession. However, the indicator is really sounding alarms for a near 100% chance of a recession given how reliable it is, DataTrek co-founder Nicholas Colas said. This was in response to the NY Fed's statement that it was signaling a 38% probability of a recession. He alluded to the model's performance over the past 60 years and noted that a probability reading of above 30% was able to anticipate a decline 9 times out of 11. It is clearly saying that high short-term interest rates are going to cause a recession in the next 12 months, Colas said. This means there is a possibility of a Fed-induced recession, or a Powell recession, as Colas refers to it. Based on the model's history, the real answer is close to 100%, Colas warned. The prospect of an economic slowdown has been a major drag on stock prices for the whole year. As a result, the S&P 500 has fallen nearly 20% from its levels in January, amid mounting inflation and aggressive rate hikes by the Fed. Market observers believe that the central bank has already over-tightened monetary policy by raising interest rates in an effort to bring down rising prices. Jamie Dimon, the CEO of JP Morgan, recently predicted that the United States might soon enter a recession, which would result in a 20% decline in stock prices. This forecast has since been reiterated by analysts working for Morgan Stanley, Bank of America, and Deutsche Bank. With so many well-known talking heads screaming about the impending doom of this recession, it's hard not to get wrapped up in all the drama. No one really knows if our economy will fall into a recession. Sure, the data shows that it is more likely to happen than in previous years, but how will that affect your investments? There is still a lot of strength in the economy. The Nasdaq is down about 30% year to date. Are the markets already pricing in a recession? Is Jamie Dimon right? Are we going to see another 20% drop in the stock market? Sure, all these scenarios are possible. However, we are more convinced to take the contrarian approach like Warren Buffett. We could see another 20% drop in the markets next year, but based on our confidence in the presidential election cycle that we discussed in a previous video, we'll continue buying stocks at a discount whenever our economy falls into a recession or not. Heck, we could all be right. Maybe the economy falls into a recession in 2023 and the market drops an additional 20% and then rebounds for healthy gains by year end. Only time will tell. We're curious to hear what you think. Do you think we're headed into a recession in 2023? Are we going to see another 20% drop in the stock market, or are we going to see healthy gains as suggested by the presidential election cycle? We'll link to that video down in the description. Let us know your thoughts in the comments, and make sure to hit the like button and subscribe to Kaboom for more videos.